Folks, this might be one of the best investing opportunities we had in many years. And honestly, I don't know when something this good will come back again. So you definitely want to listen. You may have noticed that the market isn't doing too good over the past few days. The S&P 500 is down heavy. Inflation talk is negative. CPI is hotter. And we're now talking potentially about maybe 1 to 2 rate cuts this year, maybe not at all, maybe even hikes. And there's geopolitical tensions. Iran and Israel are trying to burn the world. So this whole thing basically is leading to a lot of fear right now in the market. There's a pullback. Everybody's terrified. And the question you should be asking yourself...
Well, Tom, you just promised to us a massive investing opportunity that you haven't seen in years. What you have described is a soup of really, really bad components. Are we really talking here about a crazy investing opportunity?
Yes, allow me to explain. You need to understand what it is you're looking for, or rather, what it is you are looking at. Well, there's really 2 options. Option 1, this is the beginning of a crazy downturn. This is the beginning of the crash that everybody's waiting for. And while that may be possible, there is another scenario, which means that this whole thing is just a correction, a temporary, normal correction. So I guess the next question is, which one is it? If we go back to October of 2023, it was extreme fear. If we fast forward, all the way to just a few days ago, we were almost touching extreme greed. We're in greed, basically borderlining with extreme greed. So the market sentiment has completely flipped from October of 2023 to April of 2024. 6 months when everything has changed. Investors got super excited about AI. They got super excited about the fact that inflation is dying out, that the Fed will cut 6 times. And there was a lot of positivity in the market. And that kind of expectation, when you're expecting 6 rate cuts and then 3, and you're expecting AI companies to double every 2 years, and you're expecting all this positivity, inflation to come down to 2%, when this is the sort of expectations the market is pricing in, at some point, the market is going to need a breather to readjust to reality. And that's exactly what we're seeing here. We have CPI, we have retail spend, we have supercore, we have oil prices. This was just the match that sparked the entire fire. So the market kind of needed a break. Think of it like an ex-girlfriend that you used to have, and she just looking for an excuse to pick up a fight about anything.
Okay, you sound upset.
Why would I be upset?
The market needed to pull back. Inflation was there, ripe for the picking, and inflation is now the reason that we're seeing this pullback and this correction. There's definitely a possibility that the market will keep diving down for sure. But for this to happen, we need some underlying weakness in the economy, in the unemployment section, in the GDP. Something big needs to break from an economic standpoint, from a structural standpoint in the US economy for the market to go down into a deep, deep market crash. Right now, that hasn't happened, right? We have good unemployment numbers, which means mostly people are employed. GDP growth is very strong. So economically speaking, the United States economy is just too good right now to facilitate a market crash proper. So what I think we have here is a market correction, a market pullback that's basically bringing people back down to earth from the crazy expectations they developed over the past few months. So now there's 3 questions to answer in this video. Question number 1, how deep will this correction go? Question number 2, how to play this as a smart investor to make money? And question number 3, when will the big crash come? The one that's everybody's waiting for. Valid question. All of these questions I will answer in this video. So let's start with the top, the first question. So if this is a shallow correction, that's fine and dandy, but how shallow? Or rather, how deep?
Well, you haven't really told us a number, Tom.
Well, I promise you, by the end of this segment, you're going to have a number. So as I mentioned in the beginning of the segment, the main driver of this correction is inflationary expectations being readjusted back to reality. Now, we do have a benchmark that shows us exactly where we should be on the S&P 500 versus the inflation rate we got right now, the CPI rate. Back in June of 2022, when inflation was at its peak at 9% CPI, the S&P 500 was 3,800. Fast forward to June 2023, inflation got down to 3%, massive, massive drop, and the S&P 500 rose to 4,400. We definitely see a correlation between the CPI rate and the stock market. Once the CPI rate came down from 9 to 3, markets went up from 3,800 to 4,400. Fast forward to April 2024, and the CPI is 3.5%. Inflation has gotten worse. It is now 0.5 percentage point higher than what it was in June 2023. when the S&P 500 was 4,400. The only problem is we're now at 5,000. In fact, we were just at 5,200 just a couple of days ago. So based on this formula, it's quite simple. Inflation has gotten worse since June of 2023. In June of 2023, S&P 500 was 4,400. Since then, we had bad CPI data out of March, horrible super core numbers over the past 3 months, running at an annualized rate of 8%, currently at 4.8, but the annualized rate of the super core, excluding food, excluding energy, excluding shelter, nothing volatile, running currently at a pace of 8% per year. The Middle East conflict isn't going anywhere, it seems, for now. And the Fed is no longer cutting 6, no longer cutting 3, probably cutting once or maybe twice. So based on this, we can say that the floor for this correction, this shallow correction, is going to be between 4,400 and 4,000 on the S&P 500. Now, those are big drops. I'm not saying they're not. Dropping to 4,400, that's a 12% drop. Dropping to 4,000, that's a 20% drop. How deep will this drop happen actually depends on how bad inflation becomes. And to be honest, even though wheat prices are coming down, mainly the driver of inflation for this test is going to be oil prices. So the question of how shallow or how deep this thing goes depends mainly on oil prices. So right now, we're faced with oil prices climbing because it's summertime coming up. And always in summertime, prices of oil go up because of summer travel. And on top of it, we have geopolitical tensions in the Middle East threatening to ignite the entire region, sending oil prices even higher. So basically what this means is the current trajectory is not good. We're expecting to see higher oil prices, both from the demand side because of summer months and the geopolitical tensions. That leads us to not having a good optimistic plan about what the rest of this thing looks like. But don't forget, as Doc Brown explained to Marty McFly in Back to the Future, when you go back in the past and change certain things, the timeline changes with it. So if we do have a change in the facts, such as Iran and Israel just, shake it out and basically leave it alone and the war doesn't happen, that's going to change the entire analysis. Whether CPI cools down a lot faster, that might change the analysis. So whatever we're talking about here is just kind of the assumptions that we have to work with today and what kind of trajectory they're showing us. And right now they're showing us that this shallow normal correction is going to be quite deep, which means it's going to be quite painful. And for the untrained eye, the people who are not in this community, it's going to seem like the market is absolutely tanking. But as we just talked about here, the floor is between 44 and 4,000, not anything below that. Because historically, statistically speaking, the S&P 500 pulls back 5% at least 3 times a year. It pulls back 10% at least once in a year, even in a good year. So now we're getting to the second question, which is when is the big crash coming? If this is the small correction, when will the big crash come, Tom? Well, for that to happen, we need a few factors to play in. We need unemployment to spike. We need bad economics. We need bad GDP, bad macro. We need fundamental weakness from the US economy, essentially a recession. If a recession shows up on the doorstep of the US, then we will have the big market crash, the big market pullback, the one that's not going to be just a shallow correction. There's a few indicators that we can look at here to see how close we are to that. Now, one that I like to particularly focus on is the inversion of the yield curve, the 2 and the 10-year. Whenever these two invert, the recession is a guaranteed thing. But the timing of the recession, that's a whole different enchilada. The inversion is just the beginning of a countdown that usually ends when the yield curve reinverts back again. Now, that can take days or weeks or months, or sometimes even years. The longer the wait, the longer the inversion stays on, the longer these yield curves are inverted, the bigger the crash that follows. And right now, we've been inverted for 2 years, almost 2 years, which is massive, which means that once this rubber band that we're stretching right now tears, it's going to be a very painful one. So there's nothing to discount here. Now, the longer the time we're going to keep waiting here, this is going to make the eventual collapse quite worse. Another thing I always follow is the S&P 500 average price to earnings. Because statistically speaking, going all the way back to 1972, whenever the P ratio is 25 to 27, it's very hard to make money in the following 3 years. But here's the crazy part. Whenever the P ratio of the S&P 500 goes above 27, For the next 3 years, it is literally impossible to make money if you bought at that specific peak. And right now, the S&P 500 is almost at 25, which means that we're on the brink of being too expensive to make money for the next 3 years. And if we go to 27 and above, this literally means statistically, all the way from 1972, 27 PE and above, almost there, no money to be made for the next 3 years. Guaranteed loss of money on the S&P 500. Absolutely crazy. But here's the caveat here. This is all data. S&P 500 right now is top heavy. The top 7 companies, they comprise the vast majority of the S&P 500, and they skew the numbers. They're so expensive. They're so popular. If you take this out of the calculation and you just look at the median PE, currently it's not 25. It's just 16. So there's still room if you actually adjust it. So again, depends on how you look at it. We're maybe close or maybe not, but it's definitely not something I would ignore. Another thing I want to take a look at here is how do we play this? I promised you the third question, which means how do we make money off this? Well, the first thing you have to understand is you can't forget that this is a long-term game. Go back to 1980. Since 1980 until now, we had 5 recessions. That's a major recession every decade. 10 years, recession. 10 years, recession. In those 5 recessions, you would expect the market to go absolutely off a cliff. 5 recessions in 50 years, oh my God. In those 5 recessions in 50 years, the S&P 500 returned 3,000% for its investors. So while recessions may come and go, the S&P 500, as long as you stay invested in it for the long haul, is going to take care of you quite nicely. And the reason I'm bringing this up is because there's a very innovative way of presenting this on Substack. These guys that are called Market Sentiment, they've written this beautiful piece where they took 3 hypothetical investors, hold, stay, and double. And these 3 investors basically invested in the S&P 500 for 20 years, all the way from 1999, before the dot-com crash, all the way to 2020. And the question was basically which one of them will perform the best. One was always investing in the S&P 500 every month, no matter what. One was investing all the time, but when the S&P 500 dipped 10% below the 52-week high, he started up doubling down, basically investing double the amount. And he didn't stop until the price came back up to being as close as 10% and above of the 52-week high. And the third one was basically buying the S&P 500, but whenever the price dipped to 10% below the 52-week high, he would stop buying and would not resume until the index came back up and got back into that range. If you go and you look at a 20-year period, all of them made money. Even the guy who lost money earlier was down 11% after 5 years. After 20 years, he made 123%. The only problem is that the guys who kept investing made 190% for the steady and 225% for the double. So what we learn here is a few things. Number one, the S&P 500 is a cheat code as long as you stay long enough. Simple as that. Number two, if you double down on weakness, on something that you know is a good company or a good index, that thing is going to bring you way closer to the original cost base that you would have had if you would have bought the bottom without timing the market. Now, that's one thing any smart investor should be doing right now. Another is just risk management. Now, we don't know how this thing goes. We don't know how long it goes. So you definitely want to buy some insurance. For example, trim some massive winners. If you have massive winners, take 20, 30% of the top. Take some gains, put them on the side just in case. You keep most of it in, but you take a little bit off the top, 10%, 15%, 20%, maybe even 30%. Another thing you can do is actually increase your bond exposure. Get some money market funds, get into bonds a little bit. That's going to be your insurance policy just in case. Don't forget, the top 1% of US investors have 25% allocated to bonds. That's not a joke. Another thing you can do is load up on a company that's a great business, terrific business, but a hated stock. Loading up on a stock like that during weakness, during extreme weakness, is how you make money. And a great example of a company like that can be Tesla. Tesla has lost a lot of its shine. It has dropped from $300 per share all the way down to $155 per share. It lost 9% just in the past month, 27% of the past 3 months. And if you go back 1 year, it is down 17%. It has not had a good year, let's put it this way. But if you take a look at the fundamentals of this business, which we will in a second, you find out that it may be actually selling at a massive discount. So first of all, let's scroll through the basic fundamentals of this company, which we have here in our stock MVP cards, right? So revenue is up 19% over the past year. Not amazing, but still not bad at all. Net income is up 19%. So at the bottom line, the company is growing its revenues and growing its net income, the bottom line, both by 19%. Cash and short-term investments is up 31% of the past year. So its cash position is getting stronger. It's making more money. It's generating more net income, more profitability. Assets are up 30%. Total liabilities are up 18%, which is not as fast as the assets, and it's selling at 5 times sales. Now, we're going to take a look in a second of how good or bad that 5 times sale is. Again, Stock on VP provides us a comparison of these 3 stocks, Tesla, Microsoft, and Alphabet, right? Alphabet, essentially Google, Microsoft, and Tesla. What I think to be the top 3 companies that are racing towards AI dominance, right? Obviously, we can talk about NVIDIA here, but NVIDIA is more of the hardware play. These are the software plays of the bunch, and Tesla is definitely leading in the FSD. Microsoft has the OpenAI. Google is a little bit lagging behind, but they will make a play. So these 3 companies, I think, are good comparisons, right? So the first thing I want to show you here is right now the current short interest on all these companies. So we have 0.75 on Microsoft, not available on Google, and 4% on Tesla, which means that Tesla is the most shorted of these 3 companies, which means it's the most hated. Let's scroll down here. Let's look at revenues. So revenue growth for Tesla over the past 3 years is 200%. Over the past year is 19%. Versus Microsoft's 50% and 11%. So it's growing faster than Microsoft in the 3 year, in the 1 year. Is it growing faster than Google? Yes. Over the 3 years? Yes. Over the 1 year. So Tesla has higher growth rate than Microsoft and Google. Check that box. Net income. It's not deriving the same levels of net income, but look at the growth. 19%, which is in line with Microsoft's 22% and Google's 23%. It's not as fast as generating more net income, but it's definitely on par with these 3 companies. Now let's look at cash and short-term investments. While we have Google down 2.5%, Microsoft down 18.6%, Tesla is up 31% in cash. So they're generating more cash. Look at total assets. Again, Google is up 10%, Microsoft up 29%, Tesla is up 29.5%. Again, in line. It's literally looking like a Microsoft and a Google. While Google is trading at 6.3 sales, Microsoft at 13.5 sales, Tesla is selling at 5 times sales. So Tesla is the cheapest of them all. It's not as expensive as Microsoft, and it's definitely not as expensive as any of the other plays like NVIDIA, but it's even cheaper than Google that has taken a massive beating for being the lagger in the AI space. I wouldn't say that Tesla has an exuberant pricing based on the comparison to comparables that make sense, like Microsoft and Google. Now, if we move forward to this tool right here, we have this tool that's called the scorecard. The company scorecard is basically where we rank companies based on objective data. For example, right here, we have a 3-year revenue. If the revenue is decreasing, then you lose points. If it is flat, then you get a little bit. And if it's growing, you get 10 points. So here they got 10 points. Net profit margin actually is above 10%, which means they get another 10. Cash and short-term investments is growing over the past 3 years, so they get a 10. Assets to liabilities is above 1. They get 10 points. Short interest is below 5%. Another perfect score. Institutional shareholding, they have 45%. Now, our threshold for giving a 10 here is 50. So they're almost on the verge of that 50, but they're not quite there yet. So they lose 5 points here. Scalability-wise, they're doing fine. The 3-year scalability, basically revenue versus operating expenses. Which one is growing faster? The revenue is growing much faster. Stock has basically gone parabolic after the IPO, so that's another 10 right here. And the P ratio is actually too high at 33 to get a score here because we only score you if you are below 30 for the 5 points. So they're almost there. If you can get a little bit better, they will get 5 points, but overall they get 85 out of 100, which is one of the highest score our software Stock MVP can produce for a company. I don't think I've seen the 90 since we started it, but it's pretty high. Now, if we go and we move to the valuation part, right now, Tesla should be valued at $200 per share. And that $200 per share is based on the most pessimistic, bearish case auto manufacturer analysis that I have for you. Looking at the auto business alone, without the robotaxi, without the FSD, without the robotics, without none of this, just based on Tesla's current existing sales growth and its trajectory, it's at minimum a $200 stock based on my DCF. And you can look at the underlying assumptions right here. I'm not going to go through them, but you can go at them, you can punch them, you can say it's horrible, whatever. It's your choice. But just to show you that the EBITDA growth for Tesla that I've used here is just 15%. So we got 15% on EBITDA growth, which I think Tesla will beat. We're using a 10% WACC, discount rate. And we have basically all the outline of the assumptions right here, so you can punch holes in them. But based on my understanding, Tesla is currently a $200 stock without all the future upside that they have. Now, if you factor in all the future upside, you know my price target is $1,400. That's not a secret. But this is the most bear case valuation of Tesla. Right now, if you're buying Tesla, you're getting a 30% upside and you're getting Robotaxi, NFSD, and all the other stuff basically for free. Now, I also ran a 5-year conservative, hyper-conservative assumption test for Tesla. Basically meaning, if Tesla doesn't develop the Robotaxi, if they don't develop the FSD, how much is Tesla worth in 5 years? So the most bearish case I have here is $267 per share, which means that over the next 5 years, this stock is going to make 72%, still beating out the S&P 500. And that's the worst case of the bear case. The middle ground is 511, which gives us 230%, and the optimistic bear case is 386% with 750 per share. Now, those are the most basic bear cases I have right now. My actual price target for this stock is $1,400, which is double than the base case right here, but it just kind of gives you the idea of how low can this go. And if this is selling at a 50% discount right now because the retail investment community and the institutionals are basically fearing this and having this negative reaction to all this news that we've seen. Tesla actually firing 10% of the employees, which is nothing new to Elon, nothing new to Tesla. Tesla is actually fixing the pedal on the Cybertruck, which again is normal for a new model. Tesla has all these problems with demand. Oh my God, China is closing, China is collapsing. There's all these narratives. Executives are leaving. There's plenty of negative narratives that have driven the stock all the way down to 150, allowing a very comfortable way to DCA dollar cost average into the stock. Now, the way we DCA into the stock in our community, which we talked about, is we create a threshold. We create a line, an imaginary line that's 10%, 20%, 30% below the 52-week high, which is right now a 300, as you can see right here. So if you take 10% below this line or 20%, it's your choice, to each their own. Anything below that line, we're dollar cost averaging double. Anything above that line, we're basically dollar cost averaging normal. And that way, once we open this up in 5 years, our cost basis is going to be quite close to the bottom of the stock without actually timing the market. That's the beauty of the system we teach on our academy. And by the way, what I will do on our academy meeting this week and next week, I'm going to be searching for more stocks like this. Tesla ain't the only one. There's others with quite a lot of potential. Stocks that have great businesses, but horrible stock prices. We want to find more of these, which is my mission for the next couple of weeks for my academy members and my Patreon members. There's a few spots left for you guys to join if you want to. Patreon.com/Tom Nash. You can join, you can take this process with us and find more stocks like Tesla that have a lot of upside, probably not as much hype as Tesla, so you can even probably get even better deals. And of course, you are more than welcome to join our community over Discord, where we have almost 10,000 members. It's absolutely free to join, discord.gg/Tom Nash. Here's an example of what we do on Discord. This is my moderator, Greg, who also has a terrific channel focused on technical analysis. He was the guy who was saying that 2023 is going to be a great year before Tom Lee. He's the guy who was calling oil prices to go up and Palantir and Tesla to actually drop and the entire market to take a dump way ahead of time about 2 months ago. He's the guy who said 5,200 is going to be the top. And then from that point on, we're going to be correcting, which gives you an idea what kind of value we have on Discord. Not just me posting my stuff, but guys like Greg and others that are posting valuable information, and it is free to join completely. And of course, if you want to take the next step, you can actually become a member and open up more rooms on Discord that are member rooms and academy rooms. But you can join the general chat, which you see right here, which is absolutely free to access. You have all this information, all the stuff. Check it out, discord.gg/Tom Nash. And of course, if you haven't yet, pick up a copy of Stock MVP, stock-mvp.com. It's a platform we built for you guys, the retail investors, where you can build your own DCF models, you can analyze stocks, you can learn everything about a stock within 30 seconds. And the best part is you get it for 1 week for free to try it out before we charge you, so that you can see if you like it or not. If you want to stay after that week, use the code TOM25 for 25% off for your lifetime of use. Thank you so much for staying with me for this video. I love you all. I'll see you in the next one.